Hey guys, my name is Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on yet another episode of Search Property TV. If you haven't already, smash that subscribe button, hit the bell icon, and of course, smash the like button because YouTube needs to push this video out to the people that need it. Now in this video, I am sharing my 3 ways to legally reduce your land tax bill, and of course, how to avoid it. So in this video, we're going to talk about what is land tax and how to avoid it. So keep watching if you're interested. For many, land tax is an unknown concept, a tax that they weren't even aware of when they started investing. So I'm talking to a few people now where they've come back and they've gone, hey, so Ravi, I've actually got a few investment properties. They're all in the same state, but now I'm having to pay land tax. Can you get me out of this mess? Or, hey Ravi, I've heard about land tax and I don't know exactly how to, avoid it. Is there any strategies or tactics to actually get me to avoid it? And I'm here sharing this video for anyone in Australia. We're going to cover off New South Wales, Victoria, Queensland, New South Wales, and Tasmania. So I want you to watch all the way to the end of this video. I know it sometimes can be tedious to go through a video at this length, but I'm providing you context as to why I'm talking about certain things. And of course, this can save you a shit ton of money. So keep watching. And at the end, I'm going to share with you my number 1 tip of what I'm using to actually avoid tax legally. So what is land tax? Land tax is basically a state tax that needs to get paid on the land value component, and a percentage of that gets paid back to the government because look, the government loves taxes. It doesn't matter what they say in the budget, they basically love taxes. So each state has different rules when it comes to assessing this and how much they're actually going to charge you for land tax. Now, for some, they think, well, this isn't really going to affect me because I don't have many properties. The thing is, your properties appreciate in value. And not only that, but you're probably going to purchase a few more later down the track. So why not get associated, get your head screwed on with what exactly you need to look out for and how to actually plan ahead, because you don't want to have a problem come up in 20 years and then look back and say, wow, if I spent an extra 10 minutes watching Ravi's video, I may have avoided this problem. So let's jump into it. State by state, we have a threshold, a tax-free threshold, and this is actually calculated on the land component only. So irrespective if your house is say worth $1.2 million or you bought it for $1.2 million, the land component is different to the build component, right? So it's the unimproved capital value of the property you hold. So in simple layman terms, that means the land value, not the build value. So they'll go in and they assess that, let's say for instance, it's $1.2 million that you bought it for, but the actual land value is actually worth say $400,000. So of course this would vary state to state and of course the property itself, but that gives you a bit of an idea of how it works. Now that works for houses. In units, obviously, if the land is, 1,000 square meters and then it's built up, well, if you've got 50 apartments in that block, you've got to divide the land value or the land component, divide that by how many apartments are stacked up on there, and you're going to see that there's a lower land component to the actual property. So I actually want to go through the tax-free thresholds state by state. So let's kick in. New South Wales has a threshold of $734,000. Queensland has one of $600,000, Victoria has $250,000, South Australia has $450,000, and Tasmania has $24,999. Okay, so what does this mean? It means that when they're calculating land tax, so if the entire value of your land value component in your portfolio actually falls below that threshold, it means you avoid land tax. You don't have to pay it, right? But what we often see is if you've been investing in the same state, your value gets higher and higher and higher, well, bigger, because your land value goes up. So essentially that means your land tax bill will also go up, and that's paid every single year that you hold the property for. So different rules apply if you're purchasing it as an individual versus if you're purchasing it as a company or under a trust. So in this video, I'm only covering what occurs for individuals purchasing under individual names. Now, if you want a video about how it affects you with trusts and buying in a company, then drop a comment down below. I'll be sure to make that video too. Now, a quick note here. Of course, this is not financial advice and definitely not giving tax advice. So if you do seek that sort of advice from a tax accountant, you should probably go seek a licensed professional for that. But if you don't have someone already, you can contact our team. We can point you in the right direction. So let's go through 3 tips that are used to actually reduce or avoid land tax altogether. Let's jump in. So number one, buy in different names. No, I'm not saying become Jason Bourne or James Bond where you can change your name and it's, the best thing ever. That's not what I'm saying here. What I'm saying is that you could actually purchase under your own name, or if you've got your partner and you purchase solely under her name, each individual gets this threshold. So let's say, for instance, you purchase one each. Well, you have an individual threshold of say 600,000, or your partner has one of 600,000 in that given state. So of course, if you have reached your threshold, you can just have your partner purchase. There are also so many other things you need to consider when purchasing under whose name, apart from just avoiding land tax. As I explained earlier, land tax is calculated on the land component only. So units have less land compared to a big house on, like, say, 1,000 square meter block. Because as I said in the example earlier, you have to divide that by how many units are in that development. So of course your land portion is smaller. Now, a lot of people have come out and they've obviously saying it on the phone as well when I'm chatting to them, going, look, I don't believe in units. I don't want units. They don't grow. If they don't grow, something to think here is, why are Sydney unit prices or regional New South Wales prices or Queensland or Melbourne, wherever you are, why are the prices not the same as what they were 20 years ago? Could you walk down in Sydney and purchase a unit for $50,000 in 2020 or 2021? I don't think so. So this argument that I keep hearing, it doesn't apply, because we got taught that land appreciates, buildings depreciate, but the fact is supply, demand, and uniqueness is what really drives prices up. It's not just solely looking at, oh, well, I've got heaps of land. Well, you could have heaps of land in the middle of nowhere, but no one wants to live there. So it means jack shit. Compared to a unit in a high demand area that has huge elements of uniqueness, can actually be a really good investment. So in my portfolio as well, I've got a couple of units that I've bought, and they're very strategically positioned where they can't be built in front of, and they obviously have water views in that case. And of course, the uniqueness aspect is what's really driving that price growth. These units are growing a lot quicker than some of the houses I have. So it's not just a hard and fast rule that we got taught that no, don't buy units. I've got a video specifically about this, about units and houses. If you want to go check that out, there should be a card that pops up here at some point. Otherwise, subscribe to the channel, go check out my videos. There's a lot of value in them. And number three, finally, the last one by far is my favorite way to avoid land tax, is diversification, okay? Diversification is the biggest thing, especially when you come to property investing. Now, most people think, oh, well, I'm gonna diversify, but how am I diversifying in property investing specifically? Just buy in different states. Every state has a different threshold. So what I would do is go, I'm gonna pop one in New South Wales, one in Victoria, one in South Australia, one in Tasmania, and continue that process. Now, this has multiple effects, not just about avoiding land tax. Because guys, if you don't know already, my whole theory about investing into property is exactly that, to get you some good returns. Not to go, oh, well, I can avoid tax now, I can negatively gear, I can depreciate, so I'll buy something new. At the end of the day, if you actually look at this and you're trying to avoid tax, and that's the biggest reason you're getting into property, well, that means you're trying not to gain $1 so that you lose 35 cents. Does that make sense? You're pretty much going, I'm gonna forego that growth of $1 because I don't wanna pay 35, 45 cents. Do you know how stupid that is? So when we're coming to looking at diversification, you can actually take advantage of, yes, I can avoid land tax, but what's the bigger benefit here? I've diversified my risk geographically, and every state and every suburb has a different property cycle. So in 2017, we reached the peak of the market for Sydney and Melbourne, but Adelaide did nothing in that time. Now Adelaide has its growth spurt. Now, when we look at Hobart, Launceston, Burnie in Tasmania, well, we've got a different cycle there. So what I'm saying is, not only can you take advantage of avoiding land tax altogether, because you hit each state and they've got their thresholds, and as long as your value is below that, you're good. You also take advantage of risk diversification. You get access to different markets, which means your overall property portfolio is going to continue growing, because at any point in time, each state, there is something growing, and that's exactly what you want, especially from a growth perspective for a high performing portfolio, and from a diversifying your risk perspective, because you essentially don't want to put all your eggs into one basket and say something massive was to happen in that state. Well, then you're screwed. You basically are out of the game for the next 2 years. And of course, a lot of people at the moment are getting burnt by that because they thought Sydney could never go down. Sydney prices are amazing. Well, they've been getting smashed for the last 2 years because it's been either down or sideways movements. And of course, they think it's going to come back. So now is a good time to buy. But of course, I'm not here to convince anyone. I'm here helping, trying to educate people. And of course, if you really want to take this serious, there's a link in the description below to book a strategy session. If you can't get on a strategy session, download the ebook, hit the website, look at the videos that I'm putting out on YouTube. And if you want to go do this on your own, there's elements there, there's education here that you can really use to upgrade your life. Okay, so we've spoken about the 3 tips, but I also want to show you a quick example of exactly how this works because it can be confusing. So here is an example. Let's say you bought a property worth $1 million where the land component is worth $1 million, right? The land tax threshold for 2020 in New South Wales is $734,000. So land tax rate is 1.6% in New South Wales and the standard tax rate is $100. So what we would do is we look at the land value being $1 million, we minus that from the threshold of $734,000, we then multiply that by the tax rate plus the standard tax. So that gives you a total of $4,356. Guys, this gets paid yearly. So of course, on that many properties, you probably won't feel the effects. However, as you keep building your portfolio and you just focus on one state, you're gonna end up with a big land tax bill. Now, if you end up purchasing in like a trust or something like that, where they don't have thresholds at all, that number's gonna look massive. So you've really got to figure out what's best for you. And of course, I can make a video about this if you are interested in that. You can definitely put a comment down below and I'll be sure to get around to that video. But thanks so much for watching all the way through. If you haven't already, smash that subscribe button because it means the world to me. And of course, I'm here trying to put out this education completely for free. So all you have to do is do 2 things. 1, smash the like button like that. And 2, share it with someone that actually wants to get educated, that has an interest. And it doesn't necessarily mean that you have to go and use my buyer's agency services that some people may claim. I'm actually here educating for free. I'm not here to convince you. If you want the service and you think there's value in it, then jump on a strategy call. Otherwise, enjoy the YouTube videos for free and I'll catch you guys in the next video. Thanks guys.